All right, guys, what's going on? This first lesson is going to be on auction market theory and how markets operate. So, if you hopefully you read the welcome message. If you have any questions, just shoot them off in the general chat. I believe some of these channels are gonna not allow you to post anything. That's just because for educational purposes, it'll kind of get messy. You could post things in the general chat and the homework sections. So under auction market, financial markets are an endless two-way auction where price is discovered through the negotiation of buyers and sellers. The stock and futures market, like any market, exists to facilitate trade. As a result, markets seek to reach a state of balance where there is a relative agreement between buyers and sellers. Now, the market operates, um, prices aren't pushed around through buyers and sellers. That's 100% a myth. The algorithm that delivers price understands that it's either looking for liquidity or inefficiency to trade to in order to facilitate trade. So if they know that there's certain sellers at a certain level, price will trade there before selling off, and if they know that there's certain buyers, price will trade there before running higher. Now, what creates that liquidity? So we have two different types of market participants. We have people trying to short the market and people trying to go long on the market. So if you have a premise in mind, let's say if you were bearish, now we're just looking at the U.S. dollar because it's the universal, it's the world reserve currency. And if you understand where the dollar is going, you're going to understand where every financial market is going, like where the money's being moved, where the big players are moving their money. So pretty much when the dollar is going down, it's a risk-on scenario, and all risk assets, gold, silver, I don't know, real estate, commodities, stocks, crypto, everything is gonna show some type of strength, and vice versa. So in order to short the market, let's say if this market participant, his name is Chad, and he believes that the market's gonna go down, he's gonna place a bet by going short. That's his um his position in the marketplace. He has to set He's going to sell short the market, and they're typically using limit orders to protect their capital. So let's say if you're going to take a 2% risk on your equity, let's say if you have $10,000, that represents a $200 risk, right? So if he's going to risk $200, this price point to this price point, that's how much he's risking. In order to limit his risk, he has to set a buy stop order. So if he's short the market, he has to buy his position back, but it'll be at a loss. And his take profit, which may be down here, is going to be a buy limit order, right? So once he places that order, he's creating two additional orders in the marketplace, and that creates liquidity, right? So Chad places his order, and now he adds two orders to the marketplace, right? So let's just pretend he placed his order there, right? Let's say his entry's here. I'm just going to use a short position, right? So like typically this is how you would manage your risk, right? So he's going to risk $200, let's say, and his take profit is down here, right? So his entry is at this level. His buy stop order is above the highs, and his take profit is down here, which is a buy limit order. So when he enters the marketplace, he's adding liquidity to the market by creating two additional orders on top of his entry price. So that creates liquidity, right? Let's just put it here, for example. And maybe you got down here. So let's say another participant enters the marketplace and he has a bias or narrative that is leading him to believe that this is overextended and he wants to go long on the market. Well, if he's going to buy the market at this level, he has to set up a sell stop loss and a sell limit to exit his position and take profit. So let's say if your normal risk, if you're going to risk one, whatever it is, if you have a $10,000 account and you want to risk $200, $200 is your one. If you're going to risk one, you want to try and make two or three. So Typically, these traders will have their levels at certain levels where they know the market might trade to exit their position, right? So let's say this is me, and I'm operating as smart money. I understand that there's probably likely orders up here, right? There's going to be buy orders up here. If I'm long, I want somebody on the other end of my trade that's going to buy my position, right? That allows me to sell. If I want to sell up here, there needs to be a buyer on the other end of my position. So that is the liquidity I'm looking to target, right? So either the market is going to trade to liquidity or inefficiency, but we're just talking about liquidity right now. So smart money will buy below old lows and sell above old highs. And that is the whole premise of high probability trading setups. Anything within the middle of this is a lot higher risk because the market is not as imbalanced. You need a level of imbalance on your side in order to take a trade. When the market gets too expensive, we need to be selling into it. And when the market gets too cheap, we need to be buying into that. Right? So this is premium versus discount. So with that in mind, we can find numerous examples and just try to put this into perspective with a concept, right? When I'm trading, I'm always thinking about putting myself in a position where I would be, on the floor, maybe at the Chicago Board of Exchange, and I'm trying to trade against other traders, right? So I'm trying to take Chad's money. I know that he wants to buy it up here. It doesn't really matter if, whatever price he got in. I know that there might be an order up here that I can use to pair my liquidity with, right? I'm always thinking about I need to pair my order with a seller. If you walked into a car lot, right, and you knew that there was a seller looking to buy a car at $20,000 and all you had were $15,000 cars, wouldn't you just try and milk him out of the $20,000 because you know that what he's, that's his max budget, right? So if I know that somebody's willing to buy it at a certain price, I'm trying to sell it to them at that certain price. So when I enter long, I'm looking for a level to pair my long with a seller, right? So typically, if I'm long, I'm trying to exit above old highs. And if I'm short, I'm trying to exit below old lows. And that's pretty much the premise of auction market. I'm trying to find an auctioneer or somebody participating in the market that I can unload my position on. So with this in mind, let's just go through some of these charts and we're going to find numerous examples. I mean, this is the dollar index, but we can flip over to the S&P 500. We can flip over to gold. We can look at whatever you guys want to look at. So we're going to just do this on the dollar index right now. And this is on a daily time frame. So each one of these candles represents 24 hours of a data point. So within these candles, if we drop down into lower time frames, we'll find the intraday traders liquidity. Typically, if you're looking at this 24-hour session, price doesn't quite look like this on an intraday basis. It's not going straight down. Typically, sometimes you'll have an open, it'll come down a little bit, maybe trade above the open, and then trade all the way down here. So price is fractal, and what we're trying to do is just trying to anticipate what is the most likely place that the market is going to trade to in the next week or the next day or the next 3 days. And then we can use lower time frame entries to limit our risk, get in with a tighter stop loss, and run a move and have those higher R multiples. So keep this in mind, right? Smart money is trying to sell above old highs and buy below old lows. So each time we see this in the marketplace, we need to study this. Because what does that represent? It represents a purge on all the liquidity that's above the high before it reverses. So as soon as price trades up here, it's taking in all those buy orders. and then it's going to reverse and pair those buy orders with sells. Right? So whoever is buying it up here, right? Smart money is trying to sell into this. And then they're trying to buy it back down here at a profit. So not only that, do we have intraday levels, and once we start getting good at this, you're going to see price sometimes trend or consolidate. So when it's in a consolidation, you're more likely to see these old lows being respected. When it's in a trending environment, we have to start dialing in and start trading these intraday levels. Right, so this is an intraday run on liquidity. This was on a Friday. They took out Thursday's highs, and this is where you need to be a seller. You're operating as smart money. And how a daily candle forms is typically during the morning session or right during a news release. It will trade higher, which allows you an opportunity to go short, right? And then intraday on the following day. This is Monday. On Tuesday, we ran out Monday's high, and then we took the low. So intraday, if you were to just trade this setup, which is about 24 hours from the candle open to the candle close, there's so much opportunity just within this candle. You can possibly triple whatever your risk is. Let's say if you're going to risk $100 on this move on the day, you're making $300 by the end of the day, and you hardly have to manage it. Really, you're just coming in here during an active session and trying to place a position, which I'll talk about. I'm going to start recording my live sessions just so I can explain things thoroughly. It might not be voice, it might just be text, but it'll be probably sped up 2 times to 4 times the speed because some of these trades are extremely slow. I try and find other things to do during my day, so I'm more occupied, but some of these trades take a long time to pan out. So this is a great range to study this concept, right? We have old highs here, which when the market's predominantly bearish, it's not going to trade up there, right? So each time it trades up there, it's building more and more liquidity because whoever sold it back here has their order in the marketplace, and it hasn't been filled. So every time price trades up here and they sell it, right, more and more orders are being filled in here. Right? Let's say if Chad's going to short it again here and his stop is there. And then Bob comes along and he shorts it. Now his stop is above the highs. And then I come in again and short it. Now my stop is above the highs. Well, this generates liquidity at some point that when the market's trading down here, right, we can look at this and say that these old lows were ran out. Smart money steps into the marketplace and buys the old sell stops, right? So when this gets ran out, these are sell limit orders down here. Well, sell stop orders. Because whoever's long on the market here is putting their protected position here. Well, if they're going to puke the trade and they want to sell it at a loss, I'm willing to buy it here at a discount because I understand that there's possibly engineered liquidity up here that has not been tagged. So every time Chad, Bob, and I don't know, somebody else tries to short it, their orders get built up. And they don't all have to have the same price, right? There's a layer of liquidity that's being built up in here. These are all resting orders on the market book. If that is extremely inefficient, and I know that there's likelihood of me getting paid, right? I look at this level as there's money there. I'm looking for some type of rejection in here, right? Below an old low, we reject. Once we reject here, my bias changes. I am no longer bearish on the market because we are at a steep discount. We've pushed lower multiple times, right? This is on a Tuesday also. So when a weekly candle forms, just think about if we're trying to guess the direction of 1 week, the low or the high of the week will 75 70% of the time be formed on Monday, Tuesday, or Wednesday. That's just how a weekly candle forms. If I were to pull up a weekly chart, this is 1 week in price action, right? So this is where the market opened up Sunday night. It traded down first. There's no way it's trading up and then down and then back again. That is a huge range for that to happen. So this is how the market operates. On a weekly basis, the market opens on Sunday night. It's trading down here Monday, Tuesday, or Wednesday. And what is it doing? It's picking up these orders. It's flushing people out of the marketplace, allowing smart money to position themselves long before the rally to close the week. Same thing this week, right? Open, flush out last week's low, before it rallies again. It didn't take the highs that week, right? This is a layered level of liquidity where more and more orders are being generated before the weekly close. The next week, we open Monday, Tuesday, or Wednesday down, and then we take the liquidity above the highs. Right? So on a daily basis, if I can find my place again. Here we go. In order for me to have a profitable position, right? And this is on a daily chart. You don't have to spend a whole lot of time doing this. I'm going to be walking you guys through how to analyze the market and what levels I'm looking for. Right? I don't have to get all the way up here to make money. I could have a position on Tuesday and I exit on Wednesday. That is a decent enough position for me. If I get in here, let me just remove this magnet. If I get in here on Tuesday and I buy it, right? And let's say if I have a tight stop, I could possibly exit the next day at a 3-to-1 risk reward ratio. Is that not good money? If I'm going to risk $100, I can make $300 by placing a trade and walking away. You can do that with any size account. It doesn't matter what size the account is. It just matters how you read the narrative and how you're going to trade around that. When I first started trading, I was trading $20, $10 positions. If you can learn how to trade $10, $20 positions, someday you might trade $20, $30, $40,000 positions. There are traders out there that are risking that much money. It doesn't take a whole lot. It requires you to focus on a process, a narrative, building the narrative, and trading it properly. Right? You don't need to do a whole lot to make a whole lot of money, which is the great thing about trading. We can place a trade on Tuesday and come back 3 weeks from now. Right? So there are levels where once you're in a trade, there are levels where you don't have to hold the trade all the way to target, because we honestly, when we place the trade, we don't know if it's going to get all the way up there. So you can take profits at logical levels and leave something on. So let's say if you're buying 3 contracts, you might sell 2 contracts up here above these old highs. Right? That's the auction market theory. I just need a willing seller to sell it to, or sorry, a willing buyer to sell it to if I'm long down here. Right? And let's do the calculation on that. Let's say you were to even use the daily low as your stop. Right? That's 2.3 times your money. That's pretty good. I mean, if you were to possibly scale in and add into your position as this market trades in your direction, you could possibly add on Wednesday, Thursday, Friday, and then you're not taking profits until the following week. Now, let's say if you're going to run your position all the way to this old liquidity pool. What does this end up being? This 1 to 5 times your money by placing one trade and not touching it ever again. So that's part of your trade management, is when I first started trading, I wanted to place a trade and stare at my P&L all day long. And that's probably the worst thing that you could do, because once you place this trade, you don't know if the market's going to trade up there or if it's going to keep trading lower to your loss level. It's just impossible to know that. We're such small fish in compared with some of these big players. One person can come in here and negate your trade idea. Just because they're trading at such a massive size, they can move the market themselves. But the smart money understands where the liquidity is going to be resting, because they're all trying to take the easy money. If this level has not been cleaned out yet, there's probably the most amount of orders on the order book up here, because everybody's trying to short it. This market's been down. Everybody's trying to short it, and then we get a short squeeze. So you're trying to buy markets at discount and offload your position to somebody else, right? Let's say if you were to run this trade all the way, which is probably unlikely, but let's say you were. I mean, there's various setups in here where you can possibly get long. But let's say you were to enter this position and run it all the way. Well, it's 1 to 6.5 times your money. If you're risking 1%, you're making 6.5% on one trade within 3 weeks. Now, let's say if you start getting aggressive with your account and you start scaling in each time, well, that 6% ends up being a whole lot more. And let's say if you're trading multiple markets, you have, I don't know, 2-3% risk on at any given time, and those trades all pan out. Well, it doesn't take long to add up and compound your account. So let's just keep going through here and find some more examples where there is a clear level where smart money was selling above old highs and buying below old lows. Right? Now, it doesn't mean that they're buying the old lows to send it all the way higher, right? Whoever's short here is also probably profit taking. So when they're taking profits, they have to buy back their position, which is causing this tiny spike. But in a downtrend, you're not going to get a run on these highs. But this high is still in place, right? It barely went above that and then traded lower. All right, so in a downtrend, some of these highs will be respected, and each time this trades lower, the liquidity is being built up above it. But because the overall trend is bearish, we're not looking for highs to be ran out every time. We're just looking for a price to trade up into a premium level before we sell short. So then we have a slight change in market structure, right? Below some old lows, then we get a rejection, and we're looking for possible old highs to be ran out. And this happens over and over. We can look at it at so many markets. It's really more about seeing it real time and understanding what the market is actually doing. Are we actually going to reverse at certain levels, right? This whole low, they swept that out. They took these lows here before they pushed it higher. So a lot of the time, these market reversals are based off of news releases. So the Fed is driving a lot of this sentiment. It's their currency, right? The dollar is their currency. They're 100% in control of the currency. It doesn't really matter, what our opinions are. The Fed is going to control all the markets. Look how perfect this is. So whoever Chad is, let's say Chad is just the loser. He's always losing trades, right? His stop loss is at this high. As soon as the market goes up there and tags him out, it reverses because he's on the wrong. He's getting stopped out because his liquidity. He's not providing himself enough room for error, right? They're going up there tapping the liquidity one last time before driving it lower. So we are going to have losses as traders. That's just part of doing business. There's no way that you're going to avoid losses. But when you're finding setups to trade, it's more about, is this high probability that this trade is going to go in my direction, right? We're not looking for a huge move. We're just looking for a 2, 3, 4 day move to pay us out on a weekly basis, right? So if I'm entering in here, like again, what I said on the weekly candle, when the weekly candle forms, Monday is likely to be a manipulation. They're trading this, they're sending this market lower to induce sellers, and they're going to buy up their orders before they run it out. So I'm trying to offload my position up here as a smart money buyer. In order for me to meet my target, I need to find a seller. If I'm going long here, I need to find a seller. Right? And this is your auction. I know that this is a seller up here. I'm going long here. My stop is in a logical level, and I'm trying to get paid roughly 3 times my money. It's about 2.5. Right? So we're not trying to reinvent the wheel. Every single market operates like this. This is how the market operates. The market does not use indicators. So indicators are a lagging instrument. Every indicator out there is based off of price. If you understand price, you do not need an indicator. The price is what's driving the market, not the indicator. The market is trying to generate and facilitate trade for smart money. They're facilitating trade. That's all a market does. Now, big whales, they can even send markets lower. Let's say if they know that there's going to be a predominantly huge move in the market and they're not ready to send it higher yet, well, they're going to generate the liquidity themselves. They're going to sell and force the market lower so they can buy it at a cheaper price. They don't want to buy it up here, so they're going to sell and force and induce people into the market. And then they're going to buy it back at a cheaper price before the actual bigger swing. Right? So smart money buys in down moves. They're not buying it as the market's rallying up. I know you might be looking at the crypto markets and saying, oh man, this market's up 20%. Well, guess what? Smart money is selling into that. I am selling in my positions into that rally. I am not looking to add positions. Unless the market is down, I'm not looking to go long. I want the market to be down and I want it to be weak as long as the macro trend is bullish for me to place a position. If I'm offsides, my buy is not going to work. But if the market is down and let's say, I don't know, you're expecting the dollar to drop because inflation targets are being met and they're not hiking anymore. They might actually rate cut next year, so we'll see. But when they're hiking the rates up, the dollar is pushing higher. So in 2021, there was a narrative, right? The Fed was trying to hike rates, but it's sending the dollar higher because they're battling inflation. Right? When they're hiking rates, the dollar index is gonna trade higher just because the government bonds, the yield's paying better than a risk asset, right? So when the Fed's hiking, the stock market, cryptocurrencies, everything is crashing because they're getting a bigger return on their investment, aka yield, investing in bonds, which makes the dollar go higher. If you're gonna return at a 5% on a government bond or lose 30% in the stock market or 80% in the cryptocurrency market, where is the money going? The money is not going into stocks or cryptocurrencies. It's going into government bonds. So we are going to see, right, during a bull trend, we are going to see these deep retracements flushing people out of the market before smart money buys their orders. Right? So as long as we see lows being swept and rejected, that is cause to trade higher in the marketplace. And once levels get tapped, old highs, right? Old daily highs or old daily lows, that's where we're trying to exit. Now, there's absolutely opportunities to sell short in a bullish environment, right? You just have to have a target in mind. If I'm selling short, I need a buyer. Or sorry, I need a buyer to offload my position. Because if I'm short, right? Again, I have a buy stop order above the market and a buy limit order below the market. And when I place a position, you'll eventually see what I mean. So this is all we're looking for as a homework assignment in order to study auction market theory and liquidity, right? We are just trying to run through markets and find examples where old highs are taken out and old lows are taken out. And it's just as simple as that. We do not need to make things complicated here. The more important thing is understanding narrative. What is the narrative of the market? What are they doing? Are they trapping traders? And that's basically what I'm looking for. I'm looking to find the trapped traders and take their position. Right? Because if they're taking a loss on this position, I'm trying to buy their position from them. Now, see, this takes a long time for it to pan out. This is multiple days where price is just trading into consolidation. But there's intraday opportunities within this structure, right? If it's trading up here, this is the intraday high. People are selling it short. So for a whole day, this is trading lower, right? And then if you zoom in, they're just taking this low out before trading higher. Intraday, that's all they're trying to do, right? If I remove all these, there's another opportunity here. They're taking out the previous 2 days of liquidity before driving price higher. And they're aiming for old highs to exit their position. And you can see them exiting their position. It's not really live. You're not going to be able to see it live. You have to understand when to exit. So when the market's trading up here, and let's say if I'm guiding you through a trade and I'm saying take your profits off, or take a partial and move your stop loss. If you're not doing that and then you see the market do this, what are you going to do? You're going to fucking lose your mind. You just gave back half of your profits if you didn't partial off while the market's bullish as hell. Right? And then it's just consolidating for how long? A week long? And it's driving you crazy. So within that structure, that's all we're looking for. We're looking to go long when liquidity is taken out, and we're setting a target above old highs where I believe there's going to be a seller. Sorry, a buyer. Right? I'm trying to sell my long position. So part of the homework that I want everybody to do is pick a market. Let's see. Let's go over to the S&P. I'm going to check ES futures. And we can review as many markets as you guys want to review. This phenomenon happens in every single market, every single time frame. We can drop down to a 1 minute time frame and you can find these setups. And this is the reason why trading is so powerful, is because time is fractal. Once you understand how the market operates, you can trade a very small time frame and compound your results like crazy. We're just looking for previous levels to be taken out. That one didn't get taken out. So this is a level that was engineered, right? Let's say if Chad, again, is short the market, his liquidity is being built up. And then we have more people shorting the market, and it's continually built up. So this is recently, right? Everybody thinks that stocks are going to completely collapse because that's the narrative on the media. The narrative right now is that we are in a major recession and that stocks are going to hit all-time lows. Or not, maybe not all-time lows, but it's going to retrace a lot harder than it has already. So what does the market do? The market generates interest, short interest in the market, and then it takes them out. Which is why a lot of people are losing money trying to predict the wrong direction of the market. You have to fade what the most popular opinion is and understand what direction the market might go. And if you're wrong, but at least you're limiting your loss, right? If I'm long here, let's say I'm long here and I'm trying to target the highs, right? That's a 4-to-1 risk reward ratio. Well, let's say if I tighten my stop up again and I take a loss, am I wrong? No, because the market's trading to a certain level that I predetermined. So just because you take a loss doesn't mean it was a bad trade, right? It was the execution of it. The narrative is still good. It's just your execution was poor. If you take a trade and then move your stop or take profits too early and then it runs, well, that's your execution. That has nothing to do with where the market's actually going. And that's something that I had to learn, and it took a long time to learn, right? Your execution is everything because narrative is only one part of it. And the narrative is we are trying to look for liquidity and how the market is engineering liquidity, right? So this is a setup in here, right? So it punctured these lows before rallying for a few days, right? You're going to have down days in between. These are the best days to go long on the market. When the market's down and you believe that liquidity's already been taken and you're looking for the highs, this is the best day to get in the market. You don't want to get in it up here after the market's closed, right? You're buying it at more of a premium and they're taking on more risk, right? Let's say if we were to take 2 long positions. So I bought it this day, right? Let's say I bought it this day and my target's there, right? That's a 3-to-1 risk reward ratio. Let's say you bought it the next day. If you bought it on a up day trying to chase the market and we have the same stop loss, what are you getting out of it? What are you getting out of the trade? You're getting 1-to-1, while I'm getting 3-to-1. So you can't chase price. You should be buying it as low of a price as possible with the narrative in mind that this is still bullish and we're looking for higher prices. But because it's ran down here, we don't know if it's going to keep going lower because what? This is Wednesday. What did I say? The weekly candle is most likely to form the high or low of the week on Monday, Tuesday, or Wednesday. This is Wednesday. What is the low of the week? This is the lowest point of the week, right? On Thursday, typically, most of the time, we'll have a reversal candle. The next week, Monday, Tuesday, creates the high of the week. If you're selling short on Tuesday when you're bearish, you have a 70 to 80% chance that your trade is going to be profitable. Or if you're bullish, if you're trading on Monday, Tuesday, or Wednesday, and you're buying it, well, you have a 70 or 80% chance that your trade's going to pan out. On Tuesday, if you see the market is already rallied, I don't know, this is probably 10%. Are you really going to buy into that? Because I'm trying to sell into that using old highs. I'm using this old high, and I'm using this old high. And I'm looking to exit on the other end of the trade. The other end is this low. Why? Because well, this low wasn't taken out. And that is engineered liquidity. It's either trading to inefficiency or liquidity. And that's all a market is. We need inefficiency in order to make money. And with that, I'm going to sign off. I hope you guys found this useful. I will hopefully post another video on inefficiency right after this.